Next week is full of earnings, and I want to focus on five names that tell very different stories. This is Microsoft, Meta, Sprout Farmers Market, Lemonade, and Amazon. What makes this earnings week interesting is that these are not just five stocks, they are five very different business models. Five different valuation setups and five very different risk rewards profiles. I wasn't going to start with Microsoft because everybody already knows it is a great company, but that might be exactly why this report matters. Microsoft is still one of the best businesses in the market because it's still inside cloud, enterprise software, productivity, and now AI. The growth story is still alive because these products are sticky, recurring, and deeply embedded in the how companies work. The latest verified numbers show revenue of 318 billion, net income is 125 billion, free cash flow is 72 and 9 billion, and gross margin is 68%, which is amazing. The forward P is about 19 and 8, which is still premium but not crazy for the company with this level of profitability. The main pros are clear: AI upside, Azure growth, enterprise lock-in, and huge cash flow. The main risks are also clear: CapEx intensity, slower than expected AI monetization, and valuation compression if growth disappoints. My thesis is simple. Microsoft remains one of the cleanest long-term compounders of earnings, proof that AI still is expanding the earnings base. But Microsoft is also a kind of the stock that sets a high bar, and the next company is interesting for the completely different reason. Because the story is not about enterprise dominance, it is about whether the world's biggest attention machine can keep printing cash. That takes us to Meta. Meta is one of those companies that look simple on the surface, but the real story is much bigger than ads. The company still owns one of the strongest attention engines in the world, and the real question is how much of that strength can keep converting into earnings power. Meta revenue was about 200 billion, net income was about 60 billion, gross margin was about 82%, and free cash flow was about 46 billion. That is a huge profit machine, and it explains why the stock can command a premium even when spending is elevated. What I like here is that the business still has enormous scale, strong margin, and product ecosystem that keeps people engaged for long periods. What I worry about is also obvious: heavy AI spending, reality labs losses, and the possibility that investors get impatient if capex keep rising faster than monetization. My thesis is that Meta is still one of the strongest earnings stories in large cap tech. If the report shows solid ad growth and better than feared spending, the market can easily keep rewarding it. But here's the twist. After talking about a giant profit engine, the next name is almost the opposite. A much smaller company where the growth story is quieter, more defensive, and tied to everyone consumer's behavior. It brings us to Sprouts. Sprout is the stock most people ignore until the numbers force them to pay attention. This is a grocery business, but it has a very specific story: premium positioning, healthier food, and steady store level execution. Revenue was about 13 and 1% year over year in that quarter, which tells you this is not that stable retailer. It's still growing. Longer term figure shows revenue around 8 and 9 billion and net income around 507 million. The appeal here is that grocery is defensive, but Sprout still has a room to expand if it keeps attracting the right kind of customer. The risk is that competition is fierce, consumers can trade down, and growth may slow if traffic softens. My thesis is that Sprout can work as a quiet compounder if same-store sales store growth and margin stay strong. But Sprout is a very different kind of business from Meta. And the next stock is even more different because this one is not about stable grower at all. This is a company where the market is still asking one huge question: can the story ever become profitable at scale? That takes us to Lemonade. Lemonade is kind of company that can look very exciting and very dangerous at the same time. The story is not about major business, it's about whether AI-driven insurance can eventually become a profitable model. Lemonade's latest available trailing revenue is about 737 million, while net income is around negative 165 million, and quarterly revenue growth was about 33% year over year, so the top line is still growing fast. But the business is still losing money, and that is the core issue. The valuation reflects that uncertainty with the forward PE still deeply negative, profit margin is negative, operating margin is negative, and the company still has to prove that scale can eventually lead to real earnings. The upside is that if the model works, the re-rating could be huge. The downside is that the growth can stay exciting while economics remain weak. Mentioning Lemonade also, the last quarters were cash flow positive, and that is really good things that eventually tells that they are stopping to lose money. My thesis is that Lemonade is a show me stock. If revenue keeps compounding and losses narrow faster than expected, the market could reward it sharply. If not, it stays high volatility story stock. And after a company like Lemonade, the final name feels even more important because the next business is not turnaround story or a speculative growth story. It is one of the most powerful platform companies in the world, and the real debate is how much of the power is already priced in. Amazon is still one of the best examples of company that investors keep underestimating because they keep thinking about the retail business first. The real story is AWS, advertising, logistics efficiency, and long-term margin expansion. Amazon revenue was about 716 billion and gross margin was about 50%. This is really great for the retail business, yes. The same source shows free cash flow around 7 billion, tells you how important capex and reinvestment still are for this business. Yahoo Finance also notes that free cash flow growth has been under pressure, even as revenue growth remains strong. That is why Amazon is interesting before earnings. The market wants to know whether AWS can reaccelerate and whether the company can keep turning scale into better margin. If both happen, Amazon can still surprise to the upside. If not, investors may focus too much on current cash flow and not enough on the long-term platform value. My thesis is that Amazon remains one of the strongest long-term platform stories in the market. If the reports show stronger AWS momentum and better cash conversion, I would stay bullish. The business is built for scale, and that is the reason the market keeps giving it a room. So that is the full setup. Microsoft is the quality compounder, Meta is the cash machine, Sprouts is the quiet grocery grower, Lemonade is the speculative turnaround, and Amazon is the platform giant with the multiple engines. That mix is exactly why this earnings week is worth watching, because each company tells a totally different story about growth, valuation, and risk. So if you're interested to see more similar videos, just hit like, subscribe, and see you again, guys.